Hello friends, welcome back to Trade with Books. Today I am going to explain you the chapter 2 of our value investing series, and today we'll discuss about the intrinsic value, how you can find out what is the discounted cash flow model. And this is the book security analysis you can read for value investing, and also you can see videos of Aswath Damodaran sir available on YouTube also. From there also this all content and data is I have taken to explain my community about intrinsic value. So in last chapter we have seen that there are three approaches for value investing. First was the intrinsic value, second was relative valuation, and third was option pricing model. Today we are going to discuss the first approach, intrinsic value. So what is the value of a stock? So value of any business is function of its expected cash flow and its growth rate and the risk involved. So what does that mean? That in future how much cash flow will be coming in the business, from the business, like it will generate that cash flow after its all operations. It will take some money from the market or from equity holders, then it will do its business, it will have some margins, then it will generate some cash. And how much fast or what is the growth rate of that company, and finally what are the risk involved. You can consider it simply as a human being also, like a human being working as 9 to 5 job. He has a some salary, and after cutting its expenses like vehicle charges or everything, he may be generating some cash every month and every year. Suppose a person is generating a cash of 12 lakh rupees a year, means 1 lakh rupees per month net after deducting its all cost, like the vehicle which he is using to go to office and like everything. Then the 12 lakh rupees will grow also. Every year his salary will increase. So that is the growth rate. But there are risk also. For a private company there are lot of risk. For a government servant risk may be lesser. So including all this, you can calculate the what is the value of that person in future, how much service life he is having. So based on this all things, you can also value a stock or a business. Now the next thing is, what is intrinsic value? We have understood that value, but what is the intrinsic value? So intrinsic value is a technique to value a business based on these three characteristics: cash flow, growth and risk. This is a technique. Intrinsic value is a technique. Based on these three parameters, you can you can reach to a number that what can be the intrinsic value of this business. The stocks which you are going to buy has a business behind them. If somehow you can find out what is the intrinsic value of that company, suppose Zomato, you find out that intrinsic value of Zomato company is 1.5 lakh crore rupees, and currently the stock or company is available at 2 lakh crore. So you can find out that okay, 50,000 crores are my margin of safety. So you can decide, you can take a decision whether it is enough or not. Suppose you have bought a company where the intrinsic value is only 10,000 crore, but the stocks prices are available because of that speculation and all 2 lakh crore. Then you can see that stock is available at a much higher price than its intrinsic value. So you can use this model. So how to find out intrinsic value? For that, the tool which we are going to use, or generally it is popular, is discounted cash flow, DCF model. So what can be valued with DCF model? So intrinsic value based valuation is designed for cash flow generating assets. Only the assets which are generating the cash, like a stock, a business or startup, but not for something which is not generating cash, like gold, Bitcoin, a Picasso picture, which value is in the eyes of the person who is seeing that. A picture, a good picture, it is not generating cash, but a person can still value it a lot based on his preferences, his view. So that cannot be value based on intrinsic value. So what is DCF valuation? In DCF valuation, what we do is, the value of an stock we calculate, or we reach to a value that is the present value of the expected cash flow from that asset in the coming years. In the coming years, what are the expected cash flow from that asset, and then we are discounted that cash flows for adjusting the risk involved, the risk which are involved in that cash flow, that we have to adjust in that cash flow. So what we are doing, we are using a number called discount rate, so that our estimation should not go wrong. There are two ways for DCF valuation. The first one is where you use expected cash flow without any adjustment in the cash flow. Your cash flows are still expected, not the not showed. You are not sure about these cash flows. These are just expected numbers, but still you are using that numbers. And this is the formula. You have to add this all cash flows as per this formula. E stands for expected. CF1 is first year cash flow. CF2 is second year cash flow. CFN is nth year cash flow. How to find out which is the nth year? What is your total life of the stock? How many years you have to add? This is called terminal life. That in future videos we will explain how you can reach to this number, terminal life, for your stock. Now coming to that, what is in the bottom, 1 plus R. This R is called the discount rate, which you are using for taking the sure number. You don't know this cash flow is sure or not. This is just the expected number. To make this value more reasonable, you are adding a discount rate, that is called R. Anything you divide more than 1, it will decrease. So here if it is 100 crore and you divide by 1.1, it will be lesser. It will not be 100 crore. So that is the whole gist of this formula, that total value of an asset is the sum of the expected cash flow in the future, but you are adjusting that cash flow for a risk involved with this number R, that is called discount rate, that reflects the risk of the cash flow. So this is one way where you are not changing the cash flow, expected cash flow number. But the second way is you adjust this cash flow number based on some certainty. Like these numbers are certainty equivalent of the cash flow. Here it is written certainty equivalent, means you know for sure that this much cash flow will come. Suppose a company is there where cash flow you are expecting as 100 crore, but you know that surely 90 crore will come. So here 90 crore you will take. This is called certainty number. If you take the certain number, what changes will happen? This discount rate will be decreased. Now you have to take RF. RF is the risk-free rate, which is lesser than the discount rate. So this is the change. So you can use either the expected cash flow or the certain cash flows. If you are taking certain cash flows, the R value, the discount rate will be the discount rate that is lesser than this earlier R value. RF is lesser than the R value. So both these numbers will give you value of a stock. So you have to note some points, that for an asset to have value, its expected cash flow should be positive at some point in the time over the life of the asset. What does it mean? That suppose a young startup company is there, like Zomato was there some years back. It will not make cash in the initial years because it has marketing spends and other spendings to expand. But if it is not generating cash, you have to be sure that in future it should generate a cash. Suppose you find out a company where you are not certain that in future also the cash flow will be positive or not, then the company cannot be value based on intrinsic value. Based on this valuation method, the company will be valued at none, zero, because it is not expected to generate any cash. But a company which is expected to generate cash, like Zomato started now positive cash flows, there the company has to generate a large positive cash flow, because it has to adjust that earlier year's losses also. This you have to keep in mind. So if a company you find out, like some big giants in our India, where stable cash flows are there, and you can certainly predict the cash flow of the future, you can very well value based on this method, and there the discount rate will be further less. The second thing is you can either value the entire company, the firm, or only the equity. There are two methods all companies raise fund. One is equity, one is debt. Debt is they go to bank, NBFCs, and from there they take money. And equity is their own money, whether this is private or public money, but the equity is own money. So these both are the ways of funding the business. So you can either value equity or the total business, equity plus debt. These are the two methods. So if you are valuing the equity, which cash flow number you have to take and which discount rate you have to take, this slide will tell that thing only. You don't see other things. Asset and liability. In any company there are two things, assets and liabilities. Assets are the fixed things which are already there, like its factory, its machines, inventory, everything. And there are some growth assets which will generate the cash in the future, where the company invests. These are the asset. And the liability side, two things are there, debt and equity. Means the company has taken some money as a debt, so it has to repay that loan principal amount as also as interest amount. And equity holder, it gives that cash flow as a dividend, or when the company liquidates, equity holders will get the money. So this is liability. So if you are valuing only the equity, you have to take the cash flow after debt payment and after making reinvestment needed for future growth. If you are valuing a company only for equity, what is the value of a company? Present value, whatever you will get, that will be the value of just the equity claims of the firms. That will be the value of the company just for the equity claims, no debt. So for that, if you are taking the cash flow you have to take is after debt payment and after making reinvestment needed for the future growth. And the discount rate which you will take is the cost of raising equity. Only cost of equity, not the cost of debt. Whereas if you want to value the full firm, full company, debt plus equity, where you will get the value of the entire firm, which will reflect the value of claims of all the claims, debt and equity, then you have to use the cash flow prior to the debt payment, and you have to use the discount rate, that is cost of capital. What is cost of capital? Cost of capital is actually weighted average of both cost of debt and cost of equity. So these are the two things. Then comes to how you will do discounted cash flow. So for valuing a firm, you will take pre-debt cash, and for valuing equity only, you will take after debt cash flows. And the growth rate you will take, if you are valuing a firm, you will take the growth rate of operating earnings. If you are valuing equity, you will take the growth rate of net income or EPS. Then what can be the terminal value? How long the company you can take this cash flow, for how long? That we will see how to see that in the next video. And discount rate, if you are valuing the firm, you have to take cost of capital and equity, cost of equity. How to arrive at these numbers we will see in detail in the next video. So this was the basics of intrinsic value, discounted cash flow. Now how to find out these all numbers, what is their meaning, one by one we'll see in next chapters. Hope you like the video. Consider subscribing. We'll finish this and you will get a good idea of value investing. All the best.